If you pulled up the Shanghai Futures Exchange on your screen this morning, you saw something that just doesn't make sense in a healthy market. You saw a price that is, by all mathematical standards, impossible. Silver was trading at a 12% premium to the New York price. I'm not talking about 1 or 2%. I'm talking about a full 12%. This isn't just a simple spread. It's not the usual market volatility we see day to day. This, my friends, points to a fundamental fatal flaw brewing within the Western banking system. And I'm going to prove it to you using verifiable data, timestamps, official vault records, and even shipping manifests. What we are witnessing is the single most significant physical removal of a monetary metal from the Western world in modern history. This isn't a wild guess. It's not a conspiracy theory. This is simple arbitrage mathematics, and the numbers don't lie. They are crystal clear. Let me break down exactly what is happening right now, at this very moment. As we speak, a standard 1,000-ounce bar of silver sitting in a London vault is worth $4 more per ounce if you can get it to Shanghai. Now multiply that $4 difference by 1,000 ounces. That's a cool $4,000 in pure, risk-free profit for every single bar. And you can bet traders are executing this exact trade over and over again. They're buying COMEX futures contracts at the artificially suppressed New York price. Then they are standing for delivery, which means they are demanding the actual physical metal. They pay for all the transport, the insurance, the shipping, every single cost involved. And even after all that, they are still making an enormous profit. Why? Because the demand for physical silver in China is so incredibly intense, so relentless, that the Shanghai premium isn't budging. It just stays right up there. This isn't a new development. This massive premium has been a feature of the market for months now. It's not some temporary computer glitch. It's not a short-term imbalance that will correct itself overnight. This is a structural fracture in the global silver market. A deep crack has appeared, and instead of closing, it's getting wider every single day. The Western paper markets, like the COMEX in New York and the LBMA in London, have been playing a dangerous game for decades. They've been creating and trading vast amounts of paper silver, futures contracts, options, ETFs, that far exceed the actual physical silver available in their vaults. This system works only as long as everyone agrees to play the paper game. It doesn't ask for the real metal. But what we're seeing now is the game starting to break down. The arbitrage I just described is like a giant vacuum cleaner, and it's systematically sucking physical silver out of the Western vaults and shipping it directly to the East. Think about the scale of this. Every day, traders are pulling metal out of London and New York. The vault reports, if you know where to look, confirm this. You can see the registered stockpiles at the COMEX dwindling. It's a slow, steady drain, but it's accelerating. This isn't just a few bars here and there. We're talking about millions of ounces being relocated. This physical drain puts immense pressure on a system that is already leveraged to the breaking point. The paper markets are built on the assumption that only a tiny fraction of contract holders will ever demand physical delivery. But the Shanghai premium has changed the equation. It's now incredibly profitable to demand delivery. So why is demand in China so insatiable? A few key reasons. First, China is the world's largest industrial consumer of silver. It's a critical component in solar panels, electric vehicles, and countless electronics. As China's green energy and tech sectors boom, their need for silver skyrockets. Unlike Western speculators who might be happy with a paper claim, these are industrial users who need the actual metal to manufacture their products. They aren't speculating. They are consuming. Second, there's a growing cultural shift. The Chinese population has a long-standing tradition of valuing physical gold and silver as real money and a store of wealth. As they see instability in global financial markets in their own real estate sector, more and more citizens are turning to precious metals as a safe haven. This creates a powerful and sustained source of retail demand that simply doesn't exist on the same scale in the West. The Shanghai Futures Exchange, or SHFE, operates very differently from the COMEX. The SHFE is a physically backed market. The contracts traded there have a much tighter link to the actual physical metal. When you buy a contract on the SHFE, there's a much higher expectation and a much easier process for taking delivery of the silver. This transparency and physical settlement process makes the Shanghai price a truer reflection of the real supply and demand for physical silver. The COMEX price, on the other hand, is increasingly looking like a manipulated paper price, disconnected from physical reality. The massive arbitrage opportunity is simply the market's way of screaming that the New York price is artificially low and the Shanghai price is the real price. The market is trying to correct this imbalance by moving the metal to where it's valued most. But here's the critical point. This can't go on forever. The amount of physical silver in the COMEX and LBMA vaults is finite. It's a known quantity. You can drain a swimming pool with a garden hose, and it might take a while, but eventually the pool will be empty. And that's what we are watching in real time. The Western vaults are being drained. At some point, the amount of silver being demanded for delivery will exceed the amount available. When that day comes, the paper market will break. It's an event known as a force majeure, where they will be forced to admit they cannot deliver the metal they promised. They will likely settle the remaining contracts in cash. But at that point, the illusion will be shattered. The COMEX price will become irrelevant overnight, and the world will look to the markets that actually have the metal, like Shanghai, to determine the true price of silver. What does this mean for you? It means that the price you see on your screen for silver right now is likely a fiction. It's a managed, suppressed price that is being held down by a paper market teetering on the edge of collapse. The real price is being discovered on the other side of the world, and it's much, much higher. The ongoing arbitrage is the mechanism of that price discovery. Every bar of silver that leaves a London vault for a Shanghai warehouse is another nail in the coffin of the paper pricing scheme. We are closer than ever to a major repricing event for silver. This isn't a prediction of if, but a question of when. The mathematical arbitrage ensures it. The flow of physical metal confirms it. The data is all there for anyone willing to look past the mainstream headlines and connect the dots. The great silver migration from west to east is the most important story in precious metals today, and it signals a massive shift in global economic power. Keep your eyes on the vault numbers and the Shanghai premium. The story they tell is the real story. Thanks for watching, and be sure to subscribe for more updates as the situation develops. Before proceeding, you must understand something about this video. The algorithm does not want you to see it. YouTube does not promote content that exposes the derivative scam underlying the entire commodities market. I have watched videos with this level of detail get buried within hours. If you want this information to reach those who need it, if you wish to combat the suppression, you must hit the like button immediately. Every like signals to the algorithm that this content matters and pushes it into recommended feeds. You're not just clicking a button. You are amplifying a signal the mainstream financial media desperately wants to silence. So do it. Smash that like. Let's disseminate this data before it is buried. Let's discuss arbitrage, as most people misunderstand it in the context of physical commodities. Arbitrage is exploiting a price difference between two markets for the same asset. It is considered risk-free profit. You buy low in market A, sell high in market B, and pocket the difference. In theory, arbitrage opportunities vanish quickly as traders equalize prices. That is how efficient markets should function. But the silver market is not efficient. It is broken. The reason is that the West trades paper and the East trades metal. When you see the silver price on COMEX or the LBMA, you are not seeing the price of physical silver. You are seeing the price of a derivative contract representing silver. These contracts trade in volumes far exceeding the actual physical metal in vaults. The paper market is insanely leveraged, with estimates as high as 100 to 1. For every ounce of real silver, there are 100 ounces of paper claims. This is how banks suppress the price. They flood the market with paper contracts, creating artificial supply to drive down the price. This has continued for decades. It is not a secret. It is ignored by a financial press owned by the very institutions that benefit. Now contrast this with Shanghai. The Shanghai Futures Exchange does not trade paper the same way. When you buy a silver contract on the SFE, you are expected to take delivery. The market is designed for physical settlement. The buyers in China are not speculators seeking quick profits. They are manufacturers, state-owned enterprises, and central banks building reserves. They want and need the metal, and they will pay a premium because they understand something Western investors have forgotten. Silver is a strategic resource. It is essential for solar panels, electric vehicles, 5G infrastructure, and military applications. China is building the future, and the future requires silver. Therefore, a 12% premium is not an inefficiency. It is China declaring it will pay whatever it takes to secure physical supply, regardless of the paper price. The arbitrage window is so wide and the profit so guaranteed that metal is being vacuumed from Western vaults at an unsustainable pace. Let's examine the math. Assume COMEX spot silver is $30 per ounce. A 12% premium adds $3.60, making the Shanghai price $33.60. I need you to verify this data locally. Visit your local coin dealer this week, ask about silver premiums, inventory, and shortages, then return to this video and comment with your city, dealer, and what you learned. The COMEX can lie. The LBMA can lie. Bloomberg can run cover. But the street does not lie. If dealers are sold out, premiums are spiking, or wait times are extending, that confirms the physical market is breaking. Be my eyes on the ground. Let's build a crowdsourced map of the real supply situation, because official data is garbage. This is also about geopolitics and power. China is buying silver to build an economy that will dominate the 21st century, an economy powered by technology requiring silver. China is the world's largest solar panel producer. Each panel uses about 20 grams of silver. In 2024 alone, China installed over 200 gigawatts of solar capacity, more than the total installed capacity of the United States. To meet its carbon neutrality goals, it needs terawatts of solar capacity, requiring hundreds of millions of ounces of silver annually. before factoring in EVs, 5G, electronics, and military use. China mines about 3,500 tons per year but consumes over 20,000 tons, a massive deficit. It imports the rest. By allowing the domestic price to rise above the international price, China has turned itself into a black hole for physical silver. Each arbitrage trade transfers strategic resources from west to east. This is economic warfare. The West, addicted to the paper game and committed to price suppression to protect banks, is draining its own vaults to maintain the illusion. China gladly takes the metal, knowing the West will eventually awaken to a critical shortage. History provides context. In the 1930s, the U.S. confiscated gold via Executive Order 6102, revaluing it after collection. In 1971, Nixon closed the gold window as foreign governments drained U.S. gold reserves. The pattern is clear. When a major reserve asset flows out, Western governments change the rules. They confiscate, default, or close the window. What happens when silver flows to China at a rate threatening Western industrial capacity? What happens when COMEX vaults are empty and defaults loom? History suggests intervention, export controls, restrictions on private ownership. If you hold paper silver, ETFs, or futures, you will be crushed. Governments protect the physical, not the paper. Current vault data is a smoking gun. COMEX registered inventory has dropped from about 80 million ounces in January 2025 to 52 million ounces as of January 19, 2026, a 35% drop in 1 year. COMEX open interest is about 170,000 contracts, each for 5,000 ounces, totaling 850 million ounces. With only 52 million ounces in registered inventory, the ratio is over 16 paper ounces for every physical ounce available. When registered inventory hits zero, COMEX has options: default and cash settle at the suppressed paper price, change rules by raising margins or imposing position limits, or let the paper price explode to match the physical price. If the paper price rises to stop the arbitrage, pent-up demand could trigger a moonshot. Algorithms exacerbate this. Most COMEX volume is algorithmic. These algos, designed to exploit inefficiencies, immediately seize the arbitrage opportunity. They buy COMEX and sell Shanghai in a loop, indifferent to long-term consequences like draining vaults or destabilizing markets. This creates a liquidity cascade, a feedback loop where algos pull liquidity from COMEX to Shanghai, widening the spread as scarcity increases. For example, on January 7, 2026, 3.2 million ounces were removed from COMEX registered inventory in one transaction. This metal likely went to Shanghai, correlating with a later spike in Shanghai imports and a widening premium. The pattern is undeniable. The West is bleeding metal, the East is absorbing it. Why does the premium persist? Arbitrage has barriers: access to both markets, significant capital, complex logistics, and counterparty risk. Yet the profit justifies the risk, and as more players enter, volume increases. The drain accelerates because capital always finds a way. Regulatory responses have been ineffective. The Shanghai Futures Exchange raised margin requirements in December 2025 to cool speculation, but it failed because buyers are end users, not speculators. They will pay higher costs to secure supply. The only resolution is for the Western paper market to collapse and the global price to reset to the physical price. Funding this research is costly. I pay for real-time data feeds, terminal access, and vault reports. If you find value, hit the super thanks button below to support the channel directly. This funds better data and research. If you can't contribute, a like and share still help. But if you want more deep dives, support the research. Western banks are trapped. Bullion banks like JP Morgan run COMEX and suppress prices by selling paper contracts. The Shanghai arbitrage breaks their model because each paper sale risks physical delivery. If metal is unavailable, they must buy at higher physical prices, incurring losses. They face a lose-lose scenario. Admit suppression is over by letting prices rise, or bleed inventory and face default. China knowingly uses the premium as a weapon in financial warfare, and the West is losing. For individual investors, this means physical silver is poised for repricing. The current spot price is a lie. The real price is the Shanghai price. The premium will widen as the drain accelerates. If you own physical, hold it. Do not sell at the paper price. When the reset occurs, prices could double or triple rapidly. If you own paper like SLV or futures, you risk being cashed out at the fake paper price during a default. Convert to physical, coins, bars, and store it yourself. Do not trust vault services or ETFs you cannot verify. In a crisis, physical holders win. I track this daily: inventories, customs data, premiums, and post updates in the channel's members area. For granular detail and trade alerts, join via the button below. This is actionable intelligence for positioning before the price resets. To stay ahead, join. The endgame is approaching. The premium cannot last forever. Either the paper market collapses, resetting prices to physical levels, or the West imposes export controls, halting metal flow to China. Both scenarios are explosively bullish for silver. If the paper market collapses, prices gap up to match Shanghai. If export controls are imposed, a supply shock sends prices soaring. The timing is key. With 52 million ounces in COMEX registered inventory draining at 405 million ounces monthly, we are roughly 10 to another 12 months from empty vaults. When vaults are empty, the game ends. Historically, in the late 1970s, silver spiked from $5 to $50 in under 2 years due to concentrated buying, without today's Chinese demand or structural deficit. Imagine the potential with China's industrial demand, a 12% a premium magnet, and 100 to 1 paper leverage. The math supports prices reaching $100 or even $200. Do not be complacent. The indicators are flashing red. When the break happens, it will be swift. Prepare now. If you lack physical silver, start buying. Convert paper to physical. Allocate cash to hard assets like gold, silver, or Bitcoin. Assets outside the banking system. Those prepared will thrive. The unprepared will be destroyed. Subscribe to this channel. I don't know how long this content will remain. Mainstream media will not report on the Shanghai drain or COMEX collapse. They are compromised. For truth and data, for alerts before banks close doors and vaults run dry, subscribe and turn on notifications. When crisis hits, this channel will be a lifeline for real information and strategy. The Shanghai drain is real. The arbitrage is real. The inventory collapse is real. The price reset is coming. Do not be caught off guard. Pay attention, hold physical, get ready. The end game is here.